Hey everyone, welcome back to Corporate Decoder, the place where we untangle those complicated corporate filings. Today we are diving into some real estate investment trusts. And let me tell you, these guys love to shuffle money around between different partnerships and subsidiaries. It's like a shell game, but with skyscrapers. By the end, you will understand how they are performing and where they might be headed, or at least have a good laugh at how complex things can get. Today we are looking at an update to a previous filing from KKR Real Estate Select Trust, filed at the very beginning of March. Turns out the first version was missing some important financial statements from some of its subsidiaries, so this amendment is adding those in. Think of it like realizing you left the keys inside the car and needing to call a locksmith to let you in. Now let's find out what these corrected financials are telling us. The most interesting thing to look at is reports to stockholders. This is where we will get the real juicy bits of information. We are going to jump straight into those missing subsidiary reports. First up, we have KRE HQ at First LLC and its subsidiaries. Now, this group focuses on owning and leasing real estate, specifically an investment in San Jose, California. Let's dive into the numbers and see how they are doing. On their balance sheet, which is like a snapshot of what they own and owe, we see total assets of around $507 million. A large chunk of that, about $448 million, is tied up in their real estate investments after accounting for depreciation, which is the decrease in value of an asset. They are also lugging around a mortgage debt of around $402 million, which can be concerning. This leaves them with roughly $104 million in equity, which is the true ownership value, but a very small margin compared to their huge debt. Looking at their income statement, which shows how much money they made and spent over the year, we see rental revenue of about $38.5 million. After subtracting all their expenses, including property operating costs, depreciation, and interest payments, they are left with a net income of just over $1 million. Now think about that for a second. They have $507 million of assets, yet after expenses barely make $1 million, that's a return of like 0.2%. That is not very good. A deeper dive into their debts shows that most of it, over $400 million, is tied to a mortgage loan with JP Morgan Chase and Barclays. The interest rate is around 2.97%, which sounds pretty good, but even at that rate, they barely turn a profit. This raises concerns about their ability to handle any increases in interest rates or unexpected expenses. We also see that leasing commissions are about $7 million. It's interesting to note that they expect to amortize these commissions over the next few years. Their revenue is mainly coming from a single tenant, and the lease expires in December 2034. This highlights a major risk, because if that tenant decides to leave, that would hurt revenues massively. The company made a loan to Drawbridge Asset Management LLC that might raise some eyebrows. It appears to be a non-recourse note, so they cannot collect anything if it defaults. Next up, we have KRES Core MO Holdings LLC, which focuses on medical office buildings, so think doctor's offices and related healthcare facilities. Let's see how this subsidiary stacks up. Their consolidated balance sheet shows real estate investments net of depreciation of about $167 million. Total assets stand at about $120 HU. They have a better debt ratio. Looking at their income statement, they generated about $13.1 million in rental revenue, but after operating expenses, depreciation, and interest expenses, they post a net loss of nearly $4 million. That's concerning because they have good revenues, yet somehow cannot control cost and make money. They might need a financial doctor. To manage their interest rate risk, they entered into something called an interest rate swap agreement. This is a financial tool to try and protect themselves from rising interest rates. The fair value of these swaps is about $722 million. It is intended to protect themselves. The losses can mount. This is something to keep an eye on. Their mortgages payable are all interest only until maturity in 2026, which can cause some issues. When you only pay the interest, you don't reduce the principal, so you can end up paying a lot more interest over the long term. This group has multiple tenants, however, 2 of them make up a very large chunk of their revenue. Finally, we have MCHSFR Venture 3 LP. They focus on single-family residential rental properties. Let's see how they are doing in the housing market. They show total real estate assets net of depreciation of about $354 million. Their revolving credit facility is about $280 million, leaving them with a partner's capital of around $86 million. Similar to the first group, they have a huge amount of debt compared to equity. Looking at their income statement, they had rental revenue of about $23 to $4 million. However, after subtracting operating expenses, depreciation, interest expenses, and a loss on the sale of some properties, they end up with a net loss of about $26.5 million. It seems like they lose money at every turn. The revolving credit facility has an effective interest rate of 3.93%, but it is variable, which means that it could rise in the future. This group also uses interest rate caps, which are a type of derivative to protect themselves from rising interest rates. The fair value of these caps is about $6.5 million. Like the other group, this one also has related party transactions. They pay fees to affiliates for various services, which raises questions about whether those fees are fair market value. Now let's take a step back and put all of this together. Overall, the financials show a mixed bag of results. KKR HQ at First LLC is barely profitable. KKR's Core MO Holdings LLC is losing money. And N-CSR Venture 3 LP is also deep in the red. It seems they can barely make money despite all the revenues and size of the assets. A common theme among these subsidiaries is heavy reliance on debt. While that can boost returns when things are going well, it can quickly become a problem when they're not. This reliance on debt and complex structures makes them vulnerable to market downturns or rising interest rates. The related party transactions also raise some questions. It's important for investors to consider whether these fees are truly justified and whether they are benefiting the parent company at the expense of the subsidiaries. While these subsidiaries have significant assets, their profitability is a real concern. I would keep a close eye on their ability to manage debt, control costs, and improve their bottom line, because that is the bottom line. Thanks for watching. If you found this helpful, please like, subscribe, and leave a comment below, especially if you have more insight on this company.